Hi everybody, thanks for coming to my channel today. Today we're going to be talking about permanent buy downs and what are they and how are they used. Well, there's two types of buy downs out there. There are temporary buy downs, which basically what happens is you give the bank a chunk of money and they lower your rate for a year or two or maybe 3 years. In this case, what we're doing is a permanent buy down is that you're giving the bank a chunk of money and they're going to lower their interest rate for an entire term of the loan, whether that's going to be 10 years, 15, 20, or maybe in 30 years. So we need to see whether or not that's going to be a program that will work for you. So kind of the definition of this is it's an upfront payment of interest. So you're actually prepaying your interest in exchange for a lower rate during the entire loan term. Okay, so hopefully that makes sense to you. Um, and we call these points. So in other words, you're paying a percentage of the loan amount, which is called a point or so. Now, they're generally more expensive than temporary buy downs. And by what I mean that is temporary buy downs are you're paying the points up front for a very short term, maybe 1, 2, or 3 years for that lower interest rate. Here you're paying that money up front and it's going to last you the entire loan. But it can help you qualify. So that's the big benefit as far as that. Great example is I did a loan for a client that was at 6%. They didn't qualify. Their debt to income ratio, they were too high and they couldn't afford the payment according to the bank. But by just lowering the payment by an eighth of the rate by an eighth of a point, they were able then to get under that ratio requirement and their loan was approved. So that worked out really good. Another great example was when rates were down really low, around 3%. Well, then people were moving into these houses, buying their first home, and they have in every intention maybe to keep that house as a rental down the road. So what they did is they paid extra points to get a lower rate. So maybe they paid it down to 2.5, and they'll never ever sell that house, and they'll have the super low rate forever and ever. So that's a good reason for doing that. And sometimes, as far as the seller, will actually help you pay for these by the form of using what they call seller concessions. It's an agreement between you and the seller that they're going to give you a chunk of money to pay for some of your closing costs and therefore help you negotiate the purchase of their house. Now, let's give you an example here to see if it makes sense. So this is just one example, and there's a lot of different ways that may work or maybe not work for you. But let's take the note rate today of 6%, and we'll look at a 30-year term, a $200,000 loan amount. Now, the payment on that's going to be $1,199. And over the course of 15 years, you'll pay that loan down to $142,097. Okay? And the total amount of interest, if you keep this loan out for 30 years, is going to be $231,676. Now let's compare it to buying down the rate. You're paying 1 point. So in this case, on a $200,000 loan amount, it's $2,000. And for that, you're going to get a rate of 5.75%. Okay. Now, your payment's going to be $1,167. So it's going to be $32 less a month than the 6% rate. And over the course of 15 years, your payment will be down, you'll pay down your balance to $140,550 versus $142. So it's about $1,600 less. So it's kind of like the break-even point because you still have to factor out your $2,000 you paid to get this. So it's really close. That's about your break-even point. But of course, if you kept the loan for 30 years, now your total amount of interest is only $220,000 versus $231,000. So it's a savings of $9,000. So you pay $2,000 up front, you save about $9,000 over the life of the loan. Is that a great deal? Yeah, it's okay, but you can see that sometimes it may or may not be beneficial for you to do this type of loan. If you were to do the permanent buy down and you're going to keep this house for 10, 15 years, it's definitely a good deal because it'll break even. You'll get your money back and maybe a little bit more. And you also may qualify for that loan. However, if you're only going to keep the house for maybe a couple of years, or maybe you're going to refinance in a couple of years because you think rates are going to go down, then maybe the temporary buy down may be the better program for you. So overall, it's really important for you, if you're interested in this type of program, for you to talk to your realtor, talk to your loan officer, and discuss this and what may be more beneficial for your situation. Because you may find a house that you may go, man, I'm going to keep this house forever. I love it. Or you might find the house and say, I'm going to remodel this house and then sell it. So in that case, a temporary buy down may be better than the permanent buy down. That covers it for today. I hope you appreciate the video, and I hope to see you again in my next video. And if you'd like it, please subscribe. I'm going to do quite a few of these, so hopefully I'll give you a lot of good information in very short videos. Have a wonderful day. Bye now.